Hey everyone, welcome to the Property Podcast. I'm Rob B with Rob D, and this is your market update. We have loads coming up this week. Of course, we talk about property prices, we talk about the wider economy, we give you a mortgage update, and talk about the ever-booming rental market. Loads coming up.
Welcome to the Property Podcast. Thank you for joining us. This is a show where we take some time away from advising a multi-million pound property fund, which you can find out more about at portfolio.co.uk, and putting together hundreds of transactions for our clients every year. And we share some of our knowledge and observations from spending all day, every day, embedded in the property market. So there's going to be lots of news in this monthly market update, but you don't have to wait a month. You can get the most important news story sent to you for free every single week by signing up to our newsletter, Property Pulse. It's a super quick way to make sure you're on top of everything you need to know as an investor in less than 5 minutes a week. So if you're not signed up already, go put that right at propertyhub.net/pulse.
So we have to start with house prices. What is happening? Well, according to the BBC website, UK house prices dropped for a fourth month in a row. And this data is taken from the Halifax. There's also various news outlets reporting on nationwide saying house prices are falling as well. And what's really interesting is that gives us the data for the full year last year. So where did we end up? Well, according to Halifax, house prices in the UK grew by just 2%. And the nationwide, a little different, saying that the UK property prices grew by 2.8% last year. So 2 or 2.8, take your pick which one you prefer. But what's really interesting to me, Rob, is two things. One, we didn't have a boom last year. We started to have a boom and then it was cancelled out and we've ended up at just a pretty normal looking year. And that's the point. This, when we look back in the future, will look like a pretty normal year. When people go in 10 years' time, oh, how did we get on 10 years ago? Oh, property prices grew about 2.8%. Must have been a pretty basic, boring year. We know it wasn't, but that's what it'll look like.
That's right. It kind of shows the silliness of choosing a 12-month calendar period when you're doing these comparisons, because I haven't done, but I bet if you took something like June to June, mid-year for 21-22, that probably would look like a boom. But when you go and look back from the future, you're always looking at the actual year, and that would give you a bit of a misleading picture about what 2022 was like, because it was a massive year of two halves. But prices are now falling. They've been falling for 4 months in a row, according to Halifax. When you look at the magnitude of that change compared to the magnitude of the growth that we've had over the last 3 years, clearly it's not much. And so if that's all it's going to do, then not a big deal. But Rob, we've shared our thoughts about what's going to happen to house prices over this year, so we don't need to necessarily remake our predictions here. But I think what's being aware of is that we've sort of got a broader view of things. We do this every day. We think about this a lot. But for people who are going to be out there looking to buy homes at the moment, they're not going to be thinking about any of that. They're going to be seeing these stories that we just reported on about house prices falling. So I think you could expect, as a result, sentiment out there among buyers, or to put it another way, your potential competitors for buying stock, to be really low at the moment.
I think it is really low, but I do believe it's improving. And early indications, and it is very early on in the year, but early indications from developers across the UK who we have great relationships with, they are telling us that they've started to make sales again. Now, they're not knocking the lights out. They are just making sales, because in November and December, they pretty much sold nothing. They struggled to make any sales at all. Of course, they did make some, but it was bare bones. So we're going to have this bit of a clash, because the data is going to continue to be quite poor when it comes to property house prices for the next few months. And that's because the data's lagging. Really, the first couple of months of this year will be how the market was performing the last couple of months of last year. So the press will continue to be negative, reporting that news. Will that be enough to dent the new year optimism that some people may have? I think there's going to be a little interesting battle around sentiment over the next few months. And will the media drive people into feeling, nope, we're going into a bad place? Or will we start to think, you know what, it's not that bad? Obviously, I hope for the latter. My personality type means that I'll be in the latter. But that's why I want to flag now, make sure you're at your podcast seats or what podcast venue, wherever you like to be when you listen to this podcast, on time next week. Because I think the market is so interesting that Rob and I are going to break down our predictions next week and go, okay, so why do we think the market is going to grow around 2%? There are some slight variances on our predictions, but we both said growth of 2% is possible. We'll get into more detail again next week of exactly what we said. But I think it's really interesting to understand our thinking behind those numbers. We've not just picked them out of thin air. So make sure you join us for next week's pod.
So we'll come back to some of this in next week's episode, but there are a few things in the news that are shaping our views about what does happen next with house prices, which of course is what everyone's interested in, because it depends on a few different things, all of which have been in the news recently. So one of them is forced sales. So obviously in 2008, we saw prices declining sharply because people had their homes repossessed by the banks. But there's a story in the FT recently that this time around, the government has been speaking to major lenders, and those lenders have agreed to show forbearance for homeowners who fall into arrears. So that's a supportive factor. Another one is supply. So if there's not much stock on the market, then that supports higher prices. And indeed, there was a story in everyone's favourite publication, Mortgage Strategy, about the fact that the amount of stock coming to market in 2023 so far, admittedly not far in, is 46% lower than it was in the end stages of 2022. So a decline in supply. And then, of course, there's interest rates, which is probably the biggest one. And interest rates, where they go, is going to be dependent on inflation. Now, the latest UK inflation figures will have been published yesterday by the time you're listening to this, but it's a couple of days' time at the time that we're recording it. So we don't know what those figures are going to show. But we do know that US inflation is slowing. And the consensus at the moment seems to be that the Federal Reserve, the US's central bank, where it's been increasing interest rates by 0.75% at its most recent meetings, is now going to take that down to 0.25% as they approach what seems like it's going to be a peak in interest rates because inflation is coming under control. So lots more about the reasons for our predictions next week, but those are a few of the factors that have been in the news just in the last week or two that play into the factors that determine prices.
And the wider economy has played into our thinking. And some very interesting news out in the last week is that GDP was up 0.1%. Which is basically the performance of our country and how well we're doing economically. We've taken a story from Reuters. I like their headline because it says, World Cup drinkers boost UK GDP, easing recession risk. So well done, World Cup drinkers. Apparently, according to Reuters, without you, we'd be in recession. So why is this interesting? Well, because a poll of economists had pointed to a 0.2% decline. So they were quite a way out. You know, going from month to month to be that far out is quite a surprise. And it's surprised a lot of people. It's probably surprised our Prime Minister as well, who seems hell-bent on telling everybody that we are going into a recession. It's like he wants it to happen. I have no idea why, but it seems like he does. Anyway, we are not in recession yet, and we might go into recession. I think what we could take from this is that if we do, it might not be as bad as everyone's made out. They've said it could be a long, shallow recession. It might just turn out to be a short, shallow recession. Or we may not get any recession at all. It is possible. So I think it's important to take on board these positive green shoots that we're seeing in terms of what could happen with these positive green shoots of a better future for our economy. Although, Rob, some newspapers don't want to see it as good news, as you spotted in The Guardian.
Yeah, I did enjoy The Guardian's headline. Economy grows by only 0.1% in November. Like, come on, guys. You were saying it was going to be terrible and it was going to fall and we're going to be in recession. So actually, 0.1% growth is good news. But they didn't seem willing to go there on the good news. But I'm glad Reuters did, and they took the drinking angle. Clearly, if you're listening to this and you're doing dry Jan, then you're a traitor to the country. You need to get boozing to make sure we don't slip back into recession.
Oh, there you go, Rob. You've given me every reason I need to break dry Jan too. I was looking for a weak excuse and you've just given it me.
Well, let's move on now to mortgages, because we've touched on mortgages already. That's one of the factors that's going to determine what happens with the property market this year. And the good news is that mortgage rates are continuing to drop. So Mortgage Strategy reporting that across every duration of fixed, 2, 3, 5 and 10, fixed rates are falling across the board. Not dramatically. And they're still higher than you'd probably expect them to be given where the base rate is at the moment. And given the fact that expectations of future interest rates have shifted dramatically over the last few months, mortgages haven't come down as far as you might expect them to, but they are improving. So it's good to start the year with mortgages moving in the right direction. I think we'll see a lot more of that in the weeks and months to come. We're on a mission to open up the benefits of property investment to as many people as possible. And we're doing it with our mobile app, Portfolio. Portfolio provides what we believe is a completely new way to access the potential benefits of property investment. while feeling just as involved as if you owned a buy-to-let. You can find out more about investing through Portfolio at portfolio.co.uk.
Onto the rental market now, and this is a very interesting market because rents are still on the up. And there's a really interesting piece in the FT, you'll find all these links in our show notes, which tells the reporter's story of trying to rent a place in London. And there's really interesting data when you look at the amount of applicants per branch. Now, it is down from the all-time high of 147 new applicants per branch, which was in September. In November, it dropped to 77 applicants, which does sound like a big drop. But pre-pandemic, the average, so normal market conditions, was 61 applicants for November. So still way above the seasonal high. And Rob, this looks set to continue, and not just for London, because Home Track have released their UK rental market report. In it, they suggest that rents will rise over the next 12 months by 4 to 5%.
That's right, and that's a lot slower than it was last year, where rental growth was 12%. So that plays into the same pattern that you were just talking about for London. But 4 to 5% is still very healthy, and the reasons that they give for that are pretty structural. It's hard to see how these are going to change anytime soon. So if you're looking at supply and demand, both of them are supporting higher rents. So rental inquiries, the demand side, are 46% above the 5-year average. The supply side, supply of rental properties, is 38% below the 5-year average. So that explains why we're seeing what we're seeing in London, but across the country as well. And another point I thought was interesting was that there is a structural undersupply of rental property. So there's been no growth in the number of rental properties available since 2015. And yet the number of people renting for various reasons, including the fact that the population's growing and grew by 500,000 people last year alone, of course, means that there are plenty more people wanting to rent. So there's more people going after the same number of properties. So we're not going to see 12% rental growth every year. Thank goodness. That wouldn't be a good thing. But a 4 to 5% increase this year kind of seems a bit on the low side when you put it next to some of those numbers I've just read out.
It does. But it creates an interesting dynamic, because that means if property prices stay stable this year, so don't go up, don't go down, but rents continue to improve, then of course yields improve, which then may attract more people to the market. Now, if property prices fall, that becomes really interesting because yields will improve even further. But if yields improve, it may attract even more people to the market. So that dynamic, that price drop, might not last that long. Again, more on this next week. But a place where yields will probably improve is Scotland. And that's because Nicola Sturgeon is making it less and less attractive for landlords to operate in that market. Yet the demand for properties is there. And it's no surprise, actually, going back to that previous report, that in the last 5 years, both Glasgow and Edinburgh are represented in the top 6 cities for rental growth. And I wouldn't be surprised if they move up that chart even further, because Nicola Sturgeon and the SNP have just increased stamp duty for landlords and second homeowners in Scotland.
I'll save you, Rob, from lots of angry people writing in from Scotland. In Scotland, it's called Land and Buildings Transaction Tax rather than stamp duty, but it's the same thing. But yes, they have increased it from 4% to 6%, which is massive. So the surcharge in England and Wales is 3%. In Scotland, now 6%. But the thing that really struck me about this, Rob, is that the amount of extra revenue this is going to generate for the Scottish government apparently is £34 million. £34 million is hardly anything in the scheme of national finances. So maybe I'm getting overly cynical, but it seems to me they might be doing this more as a signal, as a message, than they are doing it as just like, oh, where can we go looking for money? Because for the national finances, that's going to make no difference at all.
It's going to make no difference. And sometimes, as landlords, we can jump on, if you want us to operate in this market, then, you have to make it attractive. I do believe, we should pay some tax. But when you make it so unattractive as it is in Scotland, and you need rental stock, and there is a shortage of it as well. Yes, it might be popular for winning votes to say, we hit the landlords. You might get a few votes for that. I get it. But it doesn't help the people who live in your country who need places to rent. And if you already own a property in Scotland, then hold on to it, because I could see your yields increasing quite nicely, because I can't see many other people choosing to come in when they can go over the border and get into the market for a lot less. I think 34 million for a government can be wasted very, very quickly. So it's not going to make any major impact to their economy in any shape or form. This seems really, really poorly thought out. And I do hope for the people of Scotland and the tenants of Scotland that Nicola Sturgeon has a plan to bring rental properties to the market. Because if she's going to rely on landlords to do it, well, she's going to be very disappointed.
No, agreed. And this is what always baffles me about this thing. It's like, you don't want private landlords. That's cool. I get it. But where are the plans to provide more social provision? How's that going to happen? Because that's what needs to happen if you're going to discourage one group. But discouragement does not end there, Rob, because as you'll be aware, there is currently a rent freeze in Scotland. We put out a YouTube video on this a while back, which we will link to if you're unaware of it. And in that legislation, which currently runs until March, there is the provision for them to extend it. You will be shocked, stunned and amazed when I tell you that they are planning to make use of that provision and extend it from March. So it was supposed to be a rent freeze over the winter. I've kind of forgotten what the justification for it was because it was so weak, but it was something to do with it being winter. But now, despite it not being winter anymore after March, they're considering extending it for another 6 months. Now, they haven't said what the level of that will be. So it is a cap. They've capped it at 0 initially, but they could increase it and say, okay, rents can't go up by more than 3%. We don't know what that's going to be. But if you are renting out property in Scotland, that's one you'll want to keep an eye on. I'll give you an update on this in next month's market update if it's been announced by then. And of course, if you want to hear about things as they happen, then make sure you sign up for our weekly newsletter, Property Pulse, where we bring you the biggest stories you need to know about every single week. So you can sign up for that at propertyhub.net/pulse.
In other news, our larger landlords take note because Making Tax Digital has been postponed until 2026. So the HMRC has announced that Making Tax Digital for tax self-assessment or income tax self-assessment will be now phased in from April 2026. So if it comes in April in 2026, and you may understand why I sound mildly sceptical, it will be 11 years since they announced it. Wow. But even if it does come in from April 2026, it is only going to apply for people who earn more than £50,000 from their portfolios. But that will reduce, and they plan to phase it down for those who earn above £30,000 from their rental portfolios. So if you've got a large portfolio, when it eventually arrives, this will apply to you. And then for those with sort of medium-sized portfolios, it will eventually apply to you as well. So we've got a few years to keep you updated, but it may surprise you to hear we wouldn't be shocked if it was delayed again at some point in the future.
And finally, if you listened to our predictions episode a couple of weeks back, you'll know we didn't have the best year last year. But a bright spot was our hotspots, the areas where we said that there'd be the most growth in 2022. We did pretty well on that, and we need to do a bit of a victory lap about it because there wasn't much else to shout about. And this latest news story from Rightmove helpfully allows us to do that again, because it was looking at where house prices increased the most last year. And the answer was the town of Eastwood in Nottinghamshire, where house prices increased by 29%, which is incredible. And Eastwood happens to sit in the middle of two of our hotspots, Derby and Nottingham, both of which also made our hotspots list for this year. It's absolutely in the middle of the bullseye in terms of where we were targeting for growth, and some pretty spectacular growth. So based on that, it might be worth checking out all the other areas that we've selected as our hotspots in this year. We've got a YouTube video about that very subject, which we will link to in the show notes.
So beyond YouTube, in the spirit of delivering even more value, it is time for Hub Extra, the part of the show where we like to give you just a little bit more. And this week is an absolute cracker. You may remember, if you're a long-time listener, that previously we have raved about a book called Can't Hurt Me by David Goggins. It is an absolutely fantastic book, but I highly recommend that you pick up the audiobook version because in between the chapters, he gives a little more context to the story. It gives you a bit more background. So it's a fascinating listen or read, depending on how you like to consume your books. It's super motivational. So, as New Year kicked off, I happened to find in my YouTube feed a few David Goggins shorts, which are the mini YouTube videos that you get, normally about 30 seconds long. And oh my word, the David Goggins ones are absolutely brilliant. So here's a little tip for you. If you're looking to drive yourself forward this year, hopefully this podcast is assisting you and helping you on that journey, at least when it comes to property investment. But property investment is just one part of your life, and I'm sure you have other goals and aspirations beyond property. So here's my resource of the week, is to go and watch every morning a short of David Goggins on YouTube. that 30 to 60 seconds will at the very least amuse you, but probably motivate you as well. The man is on another level. He's an absolute machine. I highly recommend his first book. And in fact, I'm currently working through his second book, which has not long been released. And that's called Never Finished, Unshackle Your Mind and Win the War Within. Yeah, if you're not familiar with David Goggins, you're starting to get a feel of the type of character he is, possibly by the name of his books. So I'm holding off a recommendation yet until I finish it. But we also, here's another bonus on top, we also did a episode on that first book because it was so good and we felt like it's made such an impact on us, which we titled 6 Lessons from a Hard Mofo. And that was episode number 325. I highly recommend you listen to it. It'll capture some of the big points from his first book. Anyway, as you can tell, I'm a bit of a fan. I'm not into excuses myself. They don't sit with me. I like his attitude. I like his no excuses type policy to life. And sometimes I'll tell myself a story or an excuse when it comes to something I'm trying to do. But luckily, David Goggins is never too far away from my mind, shouting at me, calling me names, and I quickly get that out of my head. So go and check out all his stuff. It's highly recommended.
Well, then, we expect to see you back here next Thursday. No excuses, with another episode of the Property Podcast. And you'll want to listen to it because we're talking about why we made our predictions for this year. How did we come to a view about the future of the market that is so different from pretty much everyone else? It's not just blind optimism. It's not a need to be contrarian. We've based those views on what we believe to be some pretty compelling evidence. So that's what we'll be getting into next week. Do make sure you join us and make sure you're following the podcast on iTunes and Spotify so you never miss an episode. We'll see you next week. Until then, bye-bye.
Bye-bye.